Good morning. We're keeping an eye on the Federal Reserve and whether or not they do hike rates this time. However, at least according to Bloomberg, there is a 98% probability of that happening. But what do we make of the Federal Reserve commentary, and what can we expect going forward with respect to the US economy as well as the Federal Reserve's plan for it? Well, we're in conversation with Zhou. He is the Director of Emerging Markets and an economist at Commerzbank. Thank you for joining us this morning.
Thank you.
Let me start off with your expectations with respect to the Federal Reserve. What are you expecting, and what is also the scope and the ability of the Federal Reserve to carry out hikes going forward?
I think, at this moment, tonight, definitely we are going to see a Federal Reserve high. Basically, I think the market has explained that this is a dovish hike. So, which means that, even though the Fed will hike interest rates, but it looks like the overall, kind of part of the interest rates in the U.S. will be still relatively moderate. So we are not going to see a very aggressive rate hikes in the next few years. So in this case, I think our in-house view is that after tonight's hike, there will be another hike in the second half of this year.
There is also an argument against hikes, and some suggest that the borrowers have an inability to pay. Even last time when we saw a hike about 25 basis points in December, a lot of borrowers were unable to go ahead and make their payments. Secondly, the recent data also doesn't really suggest or call for a rate hike, certainly not in this Federal Reserve meet. What is your opinion in this case?
I think, from my point of view, there are definitely one indicator which is against the rate hikes, very aggressive rate hikes in the U.S. right now. The most important thing is that globally we haven't seen clearly inflation pick up. And in the U.S., the core PCE is always at around like 1.5% at this moment. And definitely after tonight's rate hike, the policy rate in the U.S. will be 1.25. So basically, the spread between the inflation and the policy rates is very, very narrow. This will be the narrowest since the global financial crisis. So I think that is something we have to watch out at this moment. And also, we know that oil price is very, very sluggish, and ECB also lowered their CPI forecast in the next 2 years. China will also see very, very soft inflation expectations and the inflation print these days. So I think that is one of the biggest concern for us to think about whether the Fed should hike very aggressively, and also whether there will be kind of risk that the Fed will not hike very aggressive in the future.
What are you keeping an eye out for when it comes to commentary from Janet Yellen and the Federal Reserve?
I think, definitely one thing the market is watching is that whether the Fed will shrink the balance sheet and at what pace they will shrink the balance sheet. So, as I mentioned, this will be a dovish hike. So, which means that definitely the market is watching, that the market expects that Janet Yellen will talk about very gradual or something like a starting point of a gradual balance sheet kind of adjustment in the next few years also. So in this case, we are going to see very, very slow kind of tapering in the U.S. in the next few quarters. So I think definitely this is one thing we have to think about. And if Fed, won't touch this topic, definitely the market will rally again.
Again, recently you have spoken about a moderation in investments in China. Can you elaborate a little and what that means for investments overall?
Sure. I think, if you watch this morning's China data, China's fixed asset investment grows 8.6% year to date in May, which is below market expectations and also below the previous reading at 8.9%. So basically what we have seen in China is that two things. One is that the overall policy tightening, including the property market, has some impact on the investment already. And also we have seen that the public spending in China has also slowed. So in this case, I think China's investment growth has already peaked in Q1, and going forward, if the GDP growth will not drop below 6.5%, we will not see China's investment will pick up again. So we'll see a gradual softening part of China's investment in the next few quarters also.
And finally, with respect to fund flows in emerging markets, in this case specifically India, what we've noticed is that the debt has had more fund flows as compared to equities. So firstly, would you expect this to continue with respect to fund flows in India, considering the interest rates are where they are? And secondly, how would you peg India as compared to some of its surrounding economies with respect to fund flows then?
Well, I think, India right now is at a very lovely position from the global investment or global investors' point of view, because we saw that RBI keep the interest rate at above 6%, but the CPI inflation in India is always trend lower. The latest reading is only 2.1%. So in this case, to some extent, we have to think about whether the RBI is behind the curve, which means that maybe they have to be a little bit more accommodative going forward. So if they become more accommodative, which means that the monetary policy right now is too tight. So from the global investor point of view, India's bond market is very attractive because they are pricing some kind of monetary kind of easing in going forward. So I think in this case, that India will continue to see capital inflows in the next few quarters or so.
It was a pleasure speaking with you. Thank you very much for your time.
Thank you.